So the key or the primary objective of analyzing any financial statements of any company is to estimate future earnings from current earnings. So you are going to see how the earnings of the companies over the period, that is the historical data, and also current earnings you will look at it, or current health of the company. With all this, you also want to estimate the future earnings. So this is your main objective while analyzing the financial statements. But unfortunately, this profit, what is reported in the annual report, is a noisy measure while determining the performance of the company's operations. See, as an analyst, you being an analyst or you being a genuine investor who wants to know more about the company's uh, past, present, and also the future, so you need to identify the major sources of revenue and profit. Just with whatever they have given, just by analyzing with the data which is available, it's very important for you to identify the major sources of revenue and profit, because the firm can have revenue from various sources. It can be operational, it can be revenue from operations, or it can be revenue from non-operations as well. But what is more important with from the analyst or the investor point of view is that we have to see what is the composition of this earnings, or what is the composition of this revenue. Is it more of from operations, or is it more of from non-operations? So I'll tell you while discussing, we will dig deeper into what is non-operating, why it is so important that we have to focus or depend on revenue from operations, that and all we'll see. So as an analyst, it's important for you to identify the major sources of revenue and also the profit, like divisions in the product lines, from where the revenue is coming from. Is it from purely from operations, or is it regular in nature? So being regular in nature will have an impact on you when you're forecasting the financial statement of the company. As an important part of the exercise of recomputing a company's earnings is to identify and segregate the non-operating items. So, as an analyst, you will not just go by whatever data is available in the annual report. You will try to see, you will try to decompose or dig into where the revenue is from. But if in case there is the company's annual reports or the statements are showing higher profits, you want to know these higher profits are because of what? What are the reasons behind this higher profits? Is it higher profits? Uh, is the profits or the earnings of this companies good? Can it sustain for longer time, or is it temporary in nature? So these things you want to understand. So when we are discussing all these things, this is where the quality of earnings come into picture. Okay, so now let's understand what is quality of earnings or earnings quality. So what do we mean by earnings quality is that so what do we mean by earnings quality is that the probability of earnings trends which is going to continue. See, if your earnings are high this year, that is not sufficient. You want to have this trend to continue for several more years. So earnings quality depends on the probability of earnings trends which is going to continue, and the extent to which this earnings could be distributable cash. Okay, so whatever the earnings the company is making, it should continue for a longer time. Okay, to be called as a quality earnings. And also this earnings should be made up of more of, or it should represent more of distributable cash. If the earnings is if the company is showing higher earnings, but if it does not have sufficient distributable cash, then we cannot call that earnings as a good quality earnings. So earnings quality depends on two things. One is whether the earnings, whatever the company is making, is there a probability of it to continue in future also? And also the earnings, what the company has earned, has more of distributable cash. So these two things or these two factors determine the quality of earnings. And as we know, quality of earnings can either be high or it can be low. When do we call earnings to be a high quality earnings is that when the earnings of a company will be called as a high quality when you can see that this earnings composes of more of distributable cash. I mean, it has sufficient cash which can be distributed. These earnings are made up of sufficient cash which can be distributed. So then we call it as a high quality earnings. And also, and this earnings, high quality earnings are those which can be derived mainly from the continuing operation, which can continue for a even in the future for a longer period of time. And moreover, when they are preparing this financial statements, the company would have followed a conservative approach. When they're measuring profits, when they are computing the profits, when they are preparing their financial statement, they would have followed more of a conservative approach or conservative method of accounting, so that if there is any fluctuation in future, and because of that fluctuation, if there is a reduction in the profits compared to whatever you have estimated or whatever you have budgeted, your uh, final estimation does not have much variations when you follow conservative. Okay, so high quality earnings, we call the earnings of a company as having high quality when it has more of distributable cash, and when the earnings are mainly from the continuing operations, and the company would have followed a conservative method of accounting or approach in preparing the financial statement. When these three things are done while preparing the financial statements, and profit that is computed in such way will be called as earnings which are of high quality. And this is what is very much required for an analyst or an investor to know when you are assessing or analyzing the financial statement. On the other hand, you call the earnings of a company as low quality earnings if in case out of the total earnings, it has only small percentage of distributable cash. Remaining, it is only accounting profits. If you don't have distributable cash, and if you have only one small portion of distributable cash, then it is one of the feature of a low quality of earnings of the company. And also, if your earnings are mainly from non-operating or non-recurring sources, then again it is low quality, it's not high quality. See, non-operating means that you're getting the income from other sources. Like for example, you would have sold the asset, some capital asset this year. Because of that, it has generated some revenue. And because of that, your earnings are being shown as high. And it is not a quality earning because it will not happen every year. This is non-recurring in nature. So another nature or the feature of low quality earnings is that if the earnings are, or if the income is derived from non-operating sources, then it becomes a low quality. And also, if the company has followed a liberal accounting policy, liberal method of preparation of your P&L account or balance sheet or cash flow statement, then also this will contribute to the low quality earnings of the company. So now we have understood what is earnings quality, and in that we can come across low quality or high quality. We have understood what is low quality earnings and what is high quality earnings. And here we have some of the examples of low quality earnings. I'll just show you. So here we have some of the examples uh, where we can see, where we can say that the earnings of this company, though it is high, it is the quality of that earnings is low. Though the numerical value of these earnings are high, the quality of that earnings tend to be low. So these, see here, see when there would be low quality earnings is that whenever there is change from the standard accounting estimate to liberal accounting estimate. For example, if the company is following a liberal accounting estimate, that is when you're estimating, you're being very liberal. Why you may be liberal? Because you want to show a very good picture about the company. Being a manager or um, being a professional in a very high position of the company who is more interested in giving a very good picture about the company. So you would tend to follow liberal accounting policy, or maybe due to many other reasons. So whenever a company follows or changes from the actual accounting estimate to liberal, than being normal, if they are being very liberal in estimating their accounts or their amounts, for example, increasing useful life of the asset. See, when you increase the useful life of the asset, what happens? Every year, the charge of depreciation would be low, right? See, for example, think that 1 lakh is the cost of the asset. And if we are following straight line method of depreciation, which is the very easiest and the more convenient one. So that time, if you are taking the life of the asset as 10 years, the depreciation amount would be much higher. But if you're taking if you are being very liberal in increasing the number of years life of the asset, say from 10 years, you are increasing it to 20 years. That means that you're following a liberal accounting estimate. You are estimating and you're following the liberal approach. So in that case, what happens that 1 lakh, you're dividing that for 20 years. So what happens, your amount of depreciation or charge of depreciation for each year will be less. So when your depreciation charge is less, what happens? Usually you show the depreciation on the debit side of the P&L account. So when your expenses are less, so your depreciation is a charge. Okay, when that is less, what happens to your net profit? The net profit obviously will increase, right? When the expense is reduced, your net profits will increase. So this is the effect of depreciation. I'm giving you just one of the example on the net profits. What happens? Your net profit looks big, but here you're following a liberal accounting policy or you are following a liberal accounting estimate method. So what happens? The quality of earnings tends to be low. This is one of the example. And another example is that, for example, uh, if you're switching to straight line method, you all know that there are two methods of depreciation. There are many methods of depreciation. Most widely and commonly used are written down value and the straight line method. Okay, written down value, we know how we calculate depreciation. This year we take 1 lakh, and if the depreciation is 10,000, we deduct 10,000 from that 1 lakh. And next year, the value of this asset would have reduced to that extent. That is 1 lakh minus 10,000. So the value of that asset at the end of the year, on that you're going to calculate depreciation for the next year. So this is called as written down value. So from written down value is more strict way of charging depreciation. Okay. And if you're changing that method of depreciation from written down value to straight line method, that means that you're moving from conservative to liberal. So if this happens also, it has an effect on the quality of earnings, which will result in low quality earnings. And also while valuing your inventory. Okay, if you're moving from FIFO from weighted average cost of valuing your inventory to FIFO, first in, first out, that means that you're moving from more conservative to liberal. So when you're doing that because of maybe inflationary times, condition in the economy, that time also your quality of the earnings will get reduced. Though the earnings look big, though the number or the value of the earnings looks big, the quality is actually very low. So this is one more example of low quality earnings. And another example is that your low quality earnings can be because of non-recurring items also. I think I discussed with you when we were talking about low quality earnings. See, whenever you're selling a asset, for example, think that this year you're selling an asset or any of your investment. So there is lot of gains or income during this year, but this is non-recurring in nature because every year you might not sell because that is not your business. So this non-recurring will increase your profits, but it will decrease your quality of earnings. And one more example for this is that think that this year you have large tax refund. You have paid more than what is required to the tax authority. So you have received the fund. Again, this we will show on the credit side of your P&L account. And because of this, your earnings will increase. But every year you cannot expect a refund from the tax authority. So these are some of the non-recurring items which will increase or enhance your earnings, but it does not enhance your quality of earnings. So quality of earnings means mainly it should come from the earnings should be because of the main operations of the business, because of the continued operations of the business. But here you are receiving the earnings from other sources other than the continued business or from the basic operations of the business. And that is one of the reason why, or one of the example where you can see that how it affects the quality of earnings. Another thing is that earnings, sometimes earnings are cyclical in nature. For example, maybe uh, during some season, the company might have higher demand. So because of that higher demand, they might have good profits. But again, it is seasonal or cyclical in nature. And again, next quarter, it might not be more because of the season. So in that case, this is also something which will bring down the quality of the earnings. And earnings can be volatile because of many other uncontrollable factors. For example, take the coffee manufacturers. If in case you all know Brazil is called as the coffee pot of the world. If Brazil cannot supply coffee, that means that demand for Indian coffee plantations or company may be high. Okay, this is a temporary nature. During that time, these companies can make higher profits. But again, it is not a continued one. Because when the Brazil resumes back in supplying coffee, obviously the demand also reduces here. It gets distributed. So these are some of the um, instances where we can see earnings to be of high value, but the quality of earnings is less. Can you all see this slide? Is it visible? Here I have the statement of P&L account. Anchal, you cannot see the slide.
It's visible.
Here in this slide, we have the P&L account, statement of profit and loss or income statement of two companies. Here it's in a hypothetical company and even the numbers are hypothetical. Just wanted to show how it affects the quality of earnings when you follow a liberal accounting policy or when you follow a conservative accounting policy. Here we have two companies. Here we have two companies called as Conservative Limited and Liberal Limited. And they have given us all the information that is required for us to know how is the quality of these earnings of these companies and the method of accounting they have followed. One follows a conservative uh, method of accounting, the other follows a more liberal method of accounting. So here we have these two companies statement for some year. Again, it's a hypothetical one. And here this conservative limited is there, this conservative company limited. This follows the accounting policies of this company. For valuing inventory, they follow weighted average cost, WAC. And for depreciation, they are following written down value. And if there is any product development cost, they are going to write off fully on the same year. So they are being more conservative. We all understand what is conservative. Conservative meaning they are more strict. They are very stringent in following the accounting methods and preparation of the financial statements. So that is what this conservative limited is doing. They are being very stringent, very strict in preparation of their financial statements. So they are being more conservative. They're following very strict policies like WDV method of depreciation, WAC method for inventory valuation, and if there are any product developmental cost or any such costs, they want to write off in the same. They're not going to carry it for longer period of time. That means they don't mind showing their profits in less in number, but they want to have a good quality earnings. That is what their intention is all about. Whereas we have another company called as liberal company. Here, this liberal company follows a very liberal policy. They are being very liberal about estimating the accounting values, and following the methods. They follow for depreciation, they are following straight line method, and for valuing the inventory, they are following first in first out, that is FIFO method. And this product development cost, what they're doing is every year they want to amortize 1/5 of this cost. So their cost, they're trying to show lesser cost. This is what it means. See here, these both companies have identical revenues, expenses, and purchases. And also they have 10,000 equity shares. So this is what it is. And tax rate obviously will be the same, 30%. Though these two companies are similar in all, when you look at when you look from all the corners, from all the angles, but the method of accounting these two companies are following are different. One is following a very strict accounting method or strict account way of maintaining their accounts and preparation of the earnings. The other one is following a very liberal policy by showing lesser cost, by showing higher profits because of lesser cost. Let's see how usually what we do when we're analyzing any financial statement, we go by earnings per share. We say we think that the company which gives or which is showing higher earnings per share, I mean commonly any layman will feel that the company is doing very well. But as a professional investor or the one who is much interested with the company, they should also know why they are having higher earnings per share, and what is the reason behind it, and what is the quality of earnings, whether it is low or high. Are they trying to um, show lesser cost and thereby increasing earnings or not? That we should be able to identify. So we'll try doing that activity here with this example. See here in this, when we look at earnings per share, so what is earnings per share of Conservative Limited here? Can you all see the earnings per share of this here?
Yes, ma'am.
Yeah. So for Conservative, the earnings per share is 16.9, whereas for Liberal Company Limited, it is 45.4. So if we do a very, what to say, very basic analysis, we just look at the earnings per share. We say that Liberal company is doing well because it is giving higher earnings per share. But when we dig deeper into it, we'll know what is the quality of earnings. Then we'll be able to say which is doing better. So if we are going just by earnings per share, we feel that Liberal company is doing well, and you would love to invest in this company. And now let's work backwards. Let's see what is the sales and what is the cost shown and other things. See here the sales, as I told you, these two companies are identical in all the angles. They have same sales, but the cost of goods sold for Conservative company it's 3 lakh, and for Liberal company it is 2 lakhs. Can you see in the second when you are looking at the expenses part of these two companies? 3 lakh is the cost of goods sold and 2 lakh is the cost of goods sold for Liberal company. So there is a difference in the cost. Conservative Limited is being more strict in showing their cost, whereas Liberal company are being more liberal in calculating their cost. And coming to depreciation also, the method of depreciation followed by Conservative company is written down value. So their depreciation is higher. Liberal company is following straight line method of depreciation. So their amount of depreciation is so much, though they are having the same. Yes? Somebody wanted to ask me something? See, when we look at the cost which is shown or estimated by Conservative companies higher compared to Liberal. Because of the different methods they are following. Though they have the same demand, same expenses, same earnings, but still we can see the difference in earnings because the method they are following for representing these items in their financial statement is different. One is following one method of calculating depreciation, where the other one is adopting another method. So as I told initially, the depreciation method adopted by conservative is written down value and liberal is straight line method. While valuing the inventory, they are the conservative companies following weighted average cost, whereas liberal is following FIFO method. So that's why their cost is also less compared to conservative, and their depreciation is less. Liberals depreciation is less compared to conservative, and product development cost, see, it is the same for both the companies, 1 lakh, but the method of showing or the method of estimating is different for these two companies. Conservative company wants to write off the entire product development cost, this one, in the same year. So they are writing off this 1 lakh entirely on the same year. But whereas liberal, they want to distribute it over the years. They want, so only 1/5 of it they are writing off this year. So what happens because of these things, the total cost or the total expenses of the liberal is less compared to your conservative. So the costs are more for conservative, whereas liberal it is less. So when the costs are less, obviously their profits will be shown at a higher value. But the method of accounting followed by liberal companies very liberal in nature. And we know that one of the feature of low quality earnings is that changing the method of accounting from normal to liberal will tell that the quality of earnings is low. And also here you can see that, say when your cost of goods sold is more in conservative, okay, the difference is 1 lakh, right? So to this extent, the conservative company would be able to save the cost, save the save some of the cash flow from operations. For example, um, see this conservative company, we can say that this conservative company is better off than the liberal by 30,000 in net cash flow from operations. That is because, see, the difference in cost between your liberal and conservative is 1 lakh. One is for conservative it is 3 lakh and for liberal it is 2 lakh. So the difference is 1 lakh. So that on that difference, if you calculate 30%, so you mean to say that 30,000. So this company is saving 30,000 tax. So when it is saving the 30,000 in cash, sorry, in tax, so this 30,000 the company is getting through from operations. From operations, it is able to derive the 30,000 and it is being able to save. And the tax is paid by your liberal companies higher compared to your conservative. So here, by following conservative policy or a stringent policy while valuing the inventory or depreciation, method of depreciation and other policies, they're able to save on taxes. And when they're able to save on taxes, that means that they're able to derive more revenue from operations, which is distributable in nature. So there is more net cash flows from operations. So here what we can say that the total earnings composes of more of distributable cash and it is primarily from operations, and also for conservative I'm talking about, and also that the method of accounting which is followed by conservative companies more strict, they are more stringent. So here we can say that though earnings per share of conservative company is low compared to liberal, but when we dig deeper into the reasons for why it is low or why it is less, we can easily understand that the quality of earnings of conservative is better, high, compared to the quality of earnings of the liberal. So this is one example where I wanted to show when you're altering the accounting methods or accounting estimates, how your earnings get affected and what is the quality of earnings. So got it, understood all of you? Were able to see the quality of earnings with an example?
Yes, ma'am.
So your quality of earnings can be low because of the changes in accounting methods or because of changes in accounting estimates. See, every time we analyze, we have sometimes, especially when you're forecasting, we estimate certain things. And we do that because of uncertainties which are inherent in business activities. So many items in the financial statements cannot be measured with precision, but we can only estimate that. And here we have seen lot of examples, especially estimation of bad debts. We estimate bad debts. Okay. Then also inventory obsolescence, then the fair value of financial instruments and the useful life of the assets, depreciable assets, warranty obligations, all these things we estimate. So the use of estimates is unavoidable. Every time, everywhere we use estimates. And when we are estimating, what happens, this estimation depends on our judgments. That is a manager, that is a company's judgment. So estimation involves judgments, and these judgments are based on the latest available and reliable information. And because of this accounting estimate, which is dependent on judgment, each of us or each company can judge in its own ways. And this also can contribute to the or can affect the quality of earnings. And one more, when I was talking about reason for reason for low quality earnings is the non-operating and non-recurring items. See, in 1 year, your gains or income might be more because of non-operating items or non-recurring items. As I told you, if in case the company has sold some capital asset in that year, more revenue, there might be more revenue during that year, or maybe they might have some higher refund. So more again, this getting a higher refund from income tax or selling the asset, capital asset, it's non-recurring. This will not happen every year. Okay, and also this is non-operating. The income you derive from these two sources are not from the basic operations of the organization, so non-recurring. So here in this also, this will also affect the quality of earnings of the company, especially this non-operating income. When many companies adopt, it will help them to some extent to hide losses from their normal business operations. So, for example, think that the company is not getting enough profits or enough earnings, enough income from the operations. But in that year, if they are able to generate revenue from other sources like selling the asset or refund from income tax, one of these two examples, what happens? It will the company will be able to show higher profits, but these profits are not from the basic operations of the organization. These are from the non-operating. Though the company can show profits, the quality of this earnings or the quality of this profit is not of good, is not good. It's a low quality earning. So this is how we need to analyze when we are analyzing the financial statement. So far we have learned how to analyze using the numbers which is given, but now you are also learning to know whether whatever they have given is of good quality or not. And how do we analyze whether it is good quality earnings or low quality earnings? We know how. There are three reasons. If we check on that, we'll be able to easily tell whether the company has good quality earnings or low quality earnings, high quality earnings or low quality earnings. Here we have some example. I have some examples here on the slide, which tells how the recurring and non-operating items can affect. See, one of the examples we will look into. Case of HDFC Bank, the net profit of this bank is was rupees 26 billion during March 31st, 2016, and this net profit included profit on sale of investment in HDFC Life of 15 billion. See, out of 26 billion, 15 billion is from the sale of investments, right? So that means from operations, the bank was able to generate the difference of it, that is 11 billion. But major portion of this profit is from sale of investments, which will not happen every year, because every year HDFC Bank may not sell the investment. So here the quality of earnings is low. And this is one of the example where you can see this non-recurring and non-operating items, how it is affecting the profit. Because of the sale of investment, the HDFC Bank is able to show 26 billion. But if in case that year, if they had not sold any investments, their profit would not have been 26 billion. Instead, it would have been 11 billion. Hope all of you are getting it.
Ma'am, can you please repeat it once?
Yeah, sure. See here, here I have some examples for non-recurring and non-operating items. As I told you, quality of the earnings depends on many factors. It should have distributable cash, and the company should follow conservative policy or conservative method of preparation of the accounts, and also it should be more from operations. Here, this first example, they have given some data about HDFC Bank for the year 2016. See, in the year 2016, this bank was able to show net profit of 26 billion. And also they've given us detailed information of what was included in this net profit. They say that in this net profit, they had included the profit on the sale of investment. Okay, so HDFC or the sale of investment, it's not a regular, right? It is like it does not happen all the time. That is not the core business. This income from the sale of investment is not from the core business. So when this happens, they say that the income from sale of business, or sorry, sale of investment is 15 billion. So this 15 billion, whatever profit that they have included in the net profit, that is 26,000. This 15 billion is not from the main operations, core operations of this organization, of this bank. So this is a non-recurring and the non-operating item. And because they have included this, they are able to show the net profit as 26 billion. But if in case think that they had not sold this investment, their net profit would have been how much?
Ma'am, 11 months.
11 billion. So, and because they have included, they are able to show higher profits. But here, though the profits look big, but the quality of earnings is not good. It is not high quality, because major portion of this earnings is from non-recurring and non-operating. You call an earning as a high quality earning when you have more of the profit or earnings from the operations of the core operations of the business. So this is one example how this non-recurring and non-operating items affect the profits, affect the quality of the profits. Okay. So like this, we
Yes,
have many more examples which will tell us how we can depict the quality of earnings and how it affects the profits. So clear about earnings, quality and cash flow. So here we learned how to relate or how to analyze the earnings quality using cash flows. And we know that earnings are of high quality when they are in cash, and higher the gap between earnings and cash flow, lower is the quality of earnings. That is, if your earnings and cash flow, if there is lot of deviation, that means that it is very difficult for the organization to convert that into cash. So it tells that the quality of earnings is less. Lower the gap between your earnings and the cash flow, higher is the quality of the earnings. So this is how we analyze the earnings of the quality of earnings of the company using the cash flow. And the measure we use for determining the quality of earnings or to know the quality of earnings is the ratio of cash flow to earnings. We take the ratio of cash flow to earnings, and the suggested ratio is 1:1. Net cash flows from operating activities divided by profit. This is the ratio we use for measuring the quality of earnings. And if it is 1:1, it says that the quality of earnings is good. So this one we use. Okay. So now let's move on to the next subtopic under earnings quality. There is a concept called as earnings management. So before we get into that, what is earnings management? What is earnings management? Any of you? Why do we have to manage the earnings?
So that we can control the non-recurring and non-recurring earnings amount.
Okay,
Reduce the gap.
very nice. You are able to use whatever you have learned so far and you are able to link that to earnings management. Okay, good. Uh, I'll tell you something now here. I think some of you might have heard about it. I'm giving you just one a kind of a short story. See, in a job interview for a company's account, think that a company has announced uh, an opening for the post of accountant. So during the job interview, everyone, that is all the candidates who had come for the interview, were given financial information. Okay, and they were asked, what is the net profit? They gave the financial information of the company. They asked them to tell the net profit. They asked them to calculate the net profit. See, all the candidates except one provided the right answer, but none of them got the job. I'll repeat again, all the candidates except one provided the correct answer, but none of them got the job. The one who was selected, I told you, except one, all had given the correct answer. But that one person who did not give the correct answer had written his answer in this way. He had written as, what do you want the net profit to be? Are you all getting it? The short story, very, very short story, which I'm trying to say. I'll repeat again, there were 4 candidates for an interview for the position of an accountant interview. And among the 4, all the 4 of them were given the financials of the company. They asked them to compute the net profit. But among these 4, 3 of them were able to compute the correct net profit and they gave the answer. But the one person was, or one candidate did not calculate any net profit. And in the end, the result was these 3 candidates who gave the correct answer did not get the job. But whereas the accountant who did not give the correct answer, in his paper he had written a question. Instead of giving the answer, he had written a question. The question read like this: what do you want the net profit to be? That means he is asking the company what the net profit should be. So this is a person who got the job. Why do you think this person got the job? why didn't the people who calculated the correct answer didn't get the job, whereas the person who wrote a question for a question got the job? Why do you think so? Anybody from
Maybe
the
because
class?
like once after fixing the net profit, we can determine the other factors according to that, so that we can decrease the expenses and improve the incomes, sales, and all those things.
Rightly answered. Rightly answered. See, just now when we were talking or discussing about earnings quality, we saw that two companies which are identical in all ways. Their sales were identical, their expenses were identical, same, but still their earnings per share differed. Their profits differed because they followed different way or different approach of accounting preparation of the financial statement. So because of this, the profits can vary, though everything else is the same. So earnings management is all about that. And earnings management, the other name we give for earnings management is creative accounting. But is it good or bad? Let's see. So what do we understand by earnings management is that by using judgment and discretion, which is available in generally accepted accounting principle, that is GAAP, or making operating decisions in order to produce a predetermined effect on the financial statements. That means, to tell it in normal language, when you want your statement to look in a different way, you can alter it. You are using the same accounting standards, but you're trying to follow something which is with which you are able to give the result which you want to give. So it's like creative account. You're creating the profits. You're creating the profits. So that's why earnings management is called as creative accounting. That is, each company can judge their situation in different ways, and due to their judgment and also due to the discretion of information that is available to them, and the way they want to represent their accounting statements, they can show it in different ways. They can either show low profits, they can either show high profits, they can show lesser cost, they can show a higher cost, depending on what the company wants. So depending on what the company wants, if they are able to prepare or present the items in the financial statements according to the discretion or according to the needs of the company, that is called as earnings management. But is earnings management good or not? So earnings management, when we discussing now, we can easily tell that there is manipulation, right? All of you agree with me? So it's like managing the items in the financial statements, then showing what it is there. So it is like you're manipulating. It is a kind of financial reporting manipulation. Earnings management is a kind of financial reporting manipulation. And here, for managing the earnings, the company can follow any three types. They can adopt three types of earnings management. One is managing the accruals, one is managing the real earnings, the other one is perpetrating fraud. So these are the three ways of managing the earnings of the company so that they can show the way they want. They can show the financial statements the way the company wants. So it's a kind of financial reporting manipulation. Earnings management is
Ma'am,
also
what are
called
those three
creative
things?
account. Huh?
Ma'am, you said three things, right? Ma'am?
Yeah. See, in three ways you can manage the earnings. The company can adopt any of these three ways in managing the earnings. Can you see in the slide? Managing accruals, managing real earnings, and perpetrating frauds. As I told you, it is a kind of manipulation in the financial statements. Your earnings management itself is like manipulation of financial reporting. So it's actually legally not advisable, but all the companies follow this, can't avoid it. And these are three ways they can do it. But most, what to say, widely used or the way of managing the earnings is managing accruals. Usually, most of the companies adopt this first type or first method for managing their earnings. And this, the short form for managing accruals is AEM, that is accrual based earnings management. Okay, well, let's understand more about this because we are more interested with this, which is widely followed. See, this accrual accounting requires managers to make critical financial reporting decisions. And how they make these financial decisions is that, especially in case of estimating the useful lives of property, plant, and equipment, determining the fair value, and selecting the depreciation method. Just now we saw a lot of examples like this in earnings quality, and testing for impairment, estimating credit losses, debts, and so on. Okay. Ideally, whenever the management is making judgment, this judgment, when they're reporting or when they're preparing the financial reports, while preparing the financial reports, the judgment made by the manager should be neutral. There should not be any bias. But most of the time, it so happens that as it's the normal human nature, there is a bias which is involved in the preparation of financial statements. But ideally, the judgment of the managers while preparation should be neutral and it should not be biased in favor of a particular results. They should not think that, okay, this year I want to show 1 lakh as profit. So keeping that as a target, they try to manipulate all the items in the financial reports while preparation of the financial reports. It should not be like that. But when it happens, it is called as earnings management, and it is one of the example of accrued based earnings management, where there's a bias which is involved to get a particular result, to get a pre-designed or pre-planned result. But however, decisions involving managerial judgment are the product of conflicting consideration. Why the managers wants to show, wants to manage earnings is that, see, many times it so happens that investors expect companies to show higher performance, superior performance in every reporting period. See, as an investor, what I expect? I expect that every year or every period, the company in which I've invested should have superior performance. So this is this is one of the reasons which will force the manager to uh, do an earnings management so that they can keep their investors satisfied. That is one thing. And also analysts expect companies to meet or beat the earnings forecast or management guidance. And other thing is that managers usually see whenever managers forecast, I mean, they do the budgeting, they would have forecasted. They would have told that they're going to achieve so much of sales or so much of profits in the next year. But if they're unable to do so, if they're unable to show so much profits, what they can do is they try to adopt this accrual based earnings management where they can manipulate the profits and show a higher profits. So this is also one of the reason which will force them to take their biased judgments while preparation of the financial reports. And also the creditors may require early payment or higher interest rate for violation of debt covenants. So this is also one reason. And majority of the shareholders wants to reduce the company's income tax expenses. So this can also force the managers to manipulate their profits. And we all know that every manager, they are paid, right? And they are paid more when the performance of the company is higher. That is, they get larger performance linked bonus. At the end of the year, manager get bonus which is dependent on the performance. So when the performance of the company is higher, obviously the managers get higher bonus. This is also one of the influential factor which can make them manipulate the financial statements or the earnings. So these are some of the reasons or consideration which will make them to take a biased judgment, biased decision, and prepare a financial statement, which is again a kind of earnings management. They're manipulating the earnings. And here we have some examples for accrual-based earnings management. First one, see, when there are two ways where you can manage the earnings, especially in case of first method, that is accrual-based earnings management. Here you may increase the income, increase the assets, and decrease the liabilities. This is one way. Or you may decrease income, decrease assets, and increase liabilities. Can one of you read this? The first example of accrual based earnings management.
Can I read, ma'am?
Yeah, sure.
So the example starts: increase income, increase assets, and decrease liabilities. So the companies want to appear successful prior to a public issue of equity or debt. So we would expect them to report a higher profit. They may raise the useful lives of assets, lower the allowance for credit losses, recognize revenue for goods sent to distributors but not yet sold, switch from WAC to FIFA in a time of inflation and reduce the warranty liability. Similar pressures exist when they are below analyst expectations. A likely shortfall in the minimum current ratio stipulated in a loan agreement may induce managers to classify current liability item as non-current. A company that is on the verge of breaching the debt covenant may structure an operating lease as a finance lease.
Yes, see, this is one of the examples where you can see the accrual-based earnings management. They're trying to manage because they want to show a good picture about the company before they want to go in for public issue. Usually, when they go in for public issue, what happens? The public wants to know how the company is performing, right? And what are their future prospects. So when the prospective investors expect that, so this is one example where the managers or the company may go in for accrual based earnings management, where they try to show a very good picture about the company by changing the methods. They are not violating anything. They're changing the methods of valuation, changing the methods of depreciation, and thereby they can alter. They try to do a creative way of reporting the financials of the company. So this is one such example. Okay, we have another example. I want one of you to read out that example where they decrease the income, decrease the assets, and increase the liabilities, and why do they do so? Anybody else? Pari? Shweta? Yudip?
Yes, ma'am.
Yeah, Yudip. Can you read the second one? Second
Yes, ma'am.
example. Yes.
Decrease income, decrease assets, increase liabilities. Companies want to minimize their income tax expenses, especially if they have to pay MAT. So we could expect them to report a lower profit. They may reduce the useful lives of asset, increase the allowance for credit losses, delay recognizing revenue for goods already sold, switch from FIFO to WAC in the time of inflation, and increase warranty liability. Similar pressure exists when they have overshot analyst expectations or are facing scrutiny for anti-competitive activities.
Thanks, Yodip. So here, see this accrual earnings management or managing the earnings, this they do either to show lower profits or either to show higher profits. And they want to show lower profits or higher profits depending on the need of the company at that point of time. As we saw in the first example, if they want to go for a public issue, they want to project a very good picture about the company. So they want to show higher profits. So to do that, they might increase the income, they might increase the assets, decrease the liabilities, which shows a very good picture. Whereas if the company wants to minimize the tax liability, that is a minimum alternate tax, MAT. So in that case, what they do is they try to show a lower income. Here the need of the company has changed because they want to show lower income and end up paying lower taxes. So they want to decrease the income, decrease the assets, and increase the liabilities. So depending on the needs of the company at that point of time, they try to adopt different methods so that they can achieve the targeted results. So this whole thing is called as earnings management. Hope all of you understood what is earnings management.